Okay, good afternoon, everybody. Hopefully, you're all doing well. We've got about 30 minutes left to get the CPI print. Hello, good morning, good afternoon, everyone. Good afternoon. So let's get into it. We don't have too much time. So CPI. So also bear in mind, I forgot to say, introduce myself. I am Tony from FinancialJuice, the head financial analyst, also running MACROACE. So first of all, what is CPI? So it measures how much consumers are paying for retail goods and services. And the way it's measured is that there are people that go to overall 26,000 retail outlets, 4,000 housing units in 87 urban areas, and prices are collected on 80,000 different goods and services. T.S. Leong says, hi, Tony. Hello to you too. Right. Key measurements then. So how's it made up? So you have housing that makes up about 42% of the report. Food and beverages, 14%, transportation, 18%, medical care, 8.5%. And then, of course, the core CPI excludes food and energy. So usually the seasonally adjusted data is preferred. Of course, that removes any of the seasonal factors like production cycles, weather, or the effects of weather, and it gives you a clearer picture as to what CPI or the inflation is for that month. But in this environment where the Fed is more or less, is at the end of their tightening cycle, you could say, that traders are still keeping an eye on all the inflation prints altogether, with the headline year-on-year print being the main one. So that's one thing to be aware of, is that although, yes, the month-to-month is the preferred one, in this environment, it's the year-on-year, whereas inflation overall at the moment. So also, let's keep going then. So difference between PC price index and CPI. So the PC inflation places a lower weight on prices of gasoline and residential rents, and focuses on the nation as a whole rather than just focusing on urban areas. The other difference is that it can kind of chop and change what it measures, whereas the CPI is restricted to a fixed basket of goods. So the PC usually gives a better gauge overall where inflation is in the US. But for CPI, measuring the urban areas where the most amount of spending happens in the US, it's key for traders to see whether or not corporate profits, whether or not, first of all, are people paying more money for the luxury goods, services, or are those prices going down because of less demand from consumers? And also businesses will be with the PPI report tomorrow. So how does it affect the markets? So the dollar tends to strengthen when the economy is growing. Stocks, underlying inflation, particularly core CPI data, is if it rises sharply within a month, it can lead to stocks taking a hit. But again, overall picture is if inflation continues to move, if inflation jumps to the upside in one report, it can mean it can lead to stocks taking a big hit, and the dollar seeing a bigger amount of appreciation in expectation that the Federal Reserve has more work to do to tighten monetary policy and bring down inflation. So that's one thing to be aware of with the stock market and how the dollar reacts. Now with the bond market, high inflation reads can lead to high yields, and in an expansionary environment, that's the same thing as well. When the economy is doing quite well, if CPI prints are higher, usually that means that businesses also raising prices because they know they can, and that consumers can deal with those prices because if they have more money in their pockets to spend on those goods and services, that's usually a good thing. But in this current environment, as said, if you do get a higher print in inflation figures, it means, like I said earlier on, the Fed has more work to do to bring down inflation. And in turn, when they raise rates, that also brings up the value of the yields on those bonds that are put out to, or that government debt that is sold on into the markets. So what was the previous report like in April? Okay, for the March report. So the index for shelter was by far the largest contributor to monthly all items increases, offset and then declined by energy index, which decreased 3.5% over the month as all major energy components indexes declined. Year-on-year inflation saw the smallest yearly increase since the period ending May 2021. All you got to understand is inflation has had a nice steady path towards the downside, except today that could be different if analysts are expecting inflation to be sticky and remain unchanged at 5% for the year-on-year rate. So this, I've shown this picture before from the BLS with their report on CPI and where inflation is headed, but you can see that the headline inflation figure has or headline inflation data with the year-on-year and the month-on-month has seen a nice steady move towards the for the year-on-year. What we can see here has seen a nice steady move towards the downside, whereas the core inflation reads has been stickier, has been a bit more difficult, as you can see here on the purple or reddish, dark reddish line, that is actually starting to creep back up towards the upside. So that's one thing that economists and the Fed are worried about, that if you do see a dip in headline inflation with the year-on-year data, but then you see a rise in the core inflation data, that makes the job more difficult for the Federal Reserve to try and bring inflation down. And they might have to hike for longer and maybe go for an extra 25 basis point hike at the June meeting, rather than going with the expected pause of what the markets and traders have been pricing in so far. Although the Federal Reserve hasn't explicitly said that they're going to be doing a pause at the next meeting, they've just left the door open by removing text that there is a further need for raising rates. So where is the economy at the moment? This is also quite a key thing to understand. What is the Federal Reserve looking at? What are traders seeing? And how will that impact the inflation report? So non-farm payrolls we had last time was at 253k compared to 265. Unemployment at 3.4% compared to 3.5. Average earnings was ticked higher to 4.4% compared to 4.2%. So when that data had come out for the average earnings, that had caused the S&P to see a decline initially, but then the non-farm payrolls figure being solid and being better than expected led to the S&P moving back towards the upside. So good news is good news unless it's to do with inflation. And that's what happened there. So average earnings year on year had ticked up by 0.2%. Employment cost 1.2% compared to 1%. PC price index coming down nicely, more or less, going, not too far off from, not too much work to do with that there at 4.2% compared to 5.1%. Core PC prices are a little bit stickier, but still coming down at 4.6% compared to 4.7%. ISM manufacturing prices paid 53.2 compared to 49.2. Services prices paid had ticked higher to 59.6 compared to 59.5. Productivity was down 2.7% compared to 1.7%. Import prices ticked lower, as well as export prices as well. The PPI data, which we get tomorrow, was at 2.7% compared to 4.6%, and the core PPI at 3.4% compared to 4.4%. So overall, yes, there are areas where inflation is ticking down in the import and export areas and the producer price index, but then you have other areas too in the manufacturing sector and the services and the non-manufacturing sector where prices are picking up. And that's why the idea of a 5% figure compared, remaining unchanged from the prior figure comes into play, and that's what a lot of economists are looking at. So that's one thing to be aware of where the economy is at the moment. So you've got a little bit more of a mixed picture than you have had in the past. So don't forget, if you enjoyed this video, if you've enjoyed it so far, and you find this content useful, don't forget to share this with your fellow friends and traders with the link, and get the word out there. So the triggers then for the economic release. Oops, did you guys hear me? Whoops, you should be able to hear me now. Apologies. So you should see there that hopefully you can hear me now. If not, we're all back. Good. Yeah, maybe hitting the like button will activate the sound. There shouldn't be an echo. You should hear me nice and clearly. Okay, so as said, the month-on-month highest mid of spot 5% with a low of spot 2%. Year-on-year, according to economists, they're looking at a high of 5.2% with a low of 4.7%. Core month-on-month high with spot 5% and a low of spot 3%. And the core year-on-year looking at 5.6% with a low estimate of 5.3%. Then the sentiment and views, I'll go through it again. So you have the World Gold Council. So what is gold's role going to be like today? Is it going to continue to come under pressure if inflation does come higher? Yes, that is a strong possibility, considering in the past when you have had higher than expected inflation prints, that has led to gold declining in favor of a rising or a strengthening dollar in anticipation of higher rates from the Federal Reserve. So this is something interesting that I picked out from the World Gold Council. They said gold demand from central banks fell to 220.4 tons in Q1, down 40% from the preceding 3 months, marking the second quarter of decline. And it's also under pressure from the Federal Reserve. So you have one side which is pricing in the Federal Reserve rate hikes and then the uncertainty of where they might end up. And then on the other side, you have the banking crisis, which caused a move to safe haven assets, particularly in gold, and, well, if you like it or not, also into Bitcoin too. So one thing to bear in mind, although, yes, the short-term reaction would be for gold to see a decline from the CPI print if it is higher than expected rather than lower, in the long term, you still have gold that has seen, from central bank's point of view, a depreciation in a depreciation of the amount that they have of gold. So that's one thing to consider, is that yes, short term we have that, and then long term we have this happening. So in the short term, it shouldn't really affect us. It shouldn't really affect that sentiment overall that we're seeing there. It shouldn't really affect what the market does, but something to be aware of what's going on with the wider picture. May 8th, so according to JP Morgan's Tai Hu, Chief Asia Market Strategist, said that unless we see a sharp turnaround in the inflation numbers, the Fed ought to be quite comfortable with where policy rates are right now. So if inflation continues to go down, or is, let's say, in line with expectation, and you don't see a figure that surprises to the upside, the Fed should be happy with that, and they will more than likely pause at the upcoming meeting in June. Also, another thing I thought was quite interesting too, what could cause stickier inflation and why economists are not looking for a lower figure for the headline print, is because partly is because of automakers and hoteliers that keep on sacrificing sales volume in favor of higher prices. So this is also another thing. Now, if there is a continuation of demand for these cars or automobiles, and also for services side too, with going to hotels and holidays, and if the summer season is coming up too, that's something that hoteliers and automakers, they don't want to overdo themselves by having prices that are cheap, and then they don't have enough supply or capacity to run for the hoteliers to run the services, then for the automakers to be able to produce their goods if they're facing supply chain issues. So that's one thing to bear in mind, is that for the likes of Ford, they're aiming to maintain stickier prices, mainly because of the chip issues that they've had in the past through the pandemic era, where they've set prices, if they did, when they do have set prices at a cheaper level, but then they realize that they don't have enough chips to make their vehicles, then that caused them to be in a sticky situation. So instead of selling at a cheaper price, they'd rather keep it at a higher price until they know that they have their supply in stock to then be able to make more cars. So sentiment for automakers and hoteliers, but I think it's also pertinent to understand that that could be the same thing as what's happening in other areas within the economy as well, not just in the automaking sector or in the services side or on the hotel or resort side. I think it's just something to be aware of, that could be the wider effect if there are supply chain issues. But how strong is that? Does that really affect the CPI report for today that much? Well, if economists are already baking in the figure to be unchanged at 5%, maybe not that much. But just something to be aware of as one of the risks that we could face from the CPI data. So, other stuff as well, May 8th. So, US interest rate strategists at Goldman Sachs and Barclays advised customers that the Fed will be less aggressive in cutting interest rates this year than markets predict. The obvious point being is that maybe traders are overdoing their bets that inflation has come under control and the Fed is more or less done with their hiking cycle. The only problem is that how long does the Federal Reserve then hold rates for until they're satisfied that inflation has gone back down to their 2% goal? That's another fear for the markets if the Fed decides to hold on for longer and maybe not go ahead with the predicted rate cuts that traders and particularly Fed swaps are looking at of 2 quarter-point cuts by the year end. Maybe they decide to hold rates until 2024, or maybe they only decide to go with one rate cut before the year ends. So that's one thing that Barclays and Goldman Sachs are making their customers aware of. There could be a longer path. It could take longer before the Federal Reserve switches and says they are going to start cutting rates even more. TS Long says, are there supply chain issues in hotels? No, I was talking about hotels, let's say with the upcoming summer season, that there's going to be a high demand for the hotel rooms. So what they want to do is make it more expensive so they're actually able to run their services without having an overbooking of the hotel spaces. And then of course you've got to supply you've got to have the team there ready to also cover those hotels that are being run. So yes, different supply chain issues that to do with the automaker side, is just to make that clear. Fed and government views. So Fed's Cook said that continued economic strength and slow disinflation could push the Fed to do more. Again, today is going to be a key report to see if we do get stickier inflation, particularly core inflation, is going to be important to look out for. Fed's Powell said rate cuts would be inappropriate given our belief that inflation will take some time to subside. Again, linking back to what Goldman Sachs and Barclays have mentioned, that it may be premature to think about rate cuts sooner rather than later. Bullard, who is one of the most hawkish members of the Federal Reserve, says he feels policy is at the low end of the restrictive zone, but it's not yet clear if it is restrictive enough to get on a downward inflation path. Fed's Goolsbee said, "I'm getting the vibes that a credit squeeze is beginning." Although we've already seen that from SVB and with PacWest and Western Alliance having those issues or those jitters, particularly with SVB, done and gone, but with PacWest and Western Alliance having those jitters, there has been a knock-on effect, a domino effect, and there has been credit tightening. So the idea of saying getting the vibes that there's a credit squeeze that is beginning kind of is a bit of a moot point, considering that it's already happening and that the Federal Reserve doesn't really have to do that much more to tighten with their monetary policy because commercial banks are already doing it. just like in the European, just like in Europe. It's also happening there, where commercial banks are tightening lending because of they don't want to, of course, hand out so many loans that that they don't have any liquidity left for themselves. In case you have a bunch of people who want to come along and say, "Hey, I want to take my money out. Things are going bad here for me in the economy," right? So that's one thing again, a moot point from Fed Goolsbee, but just to kind of show you where the mentality is with the Federal Reserve, or one of the members of the Federal Reserve at the moment. Slow. Slow. Market pricing. So 1st of May, before the Fed's rate decision on the 3rd of May, had Fed swaps showing around 2 and 3 odds of June pause after the May hike. 3rd of May, Fed swaps show firmer June hike odds, but still 1 in 3. And then 8th of May, swap contracts by Friday was still expecting 50 basis points worth of cuts by year end, but on May 8th, that had increased. So now swaps are expecting 70 basis points of cuts by year end. So again, they're expecting the Fed to take action, pivot sooner, rather than taking the time and getting to 2024, which is what they originally said, and then cutting rates. So this was the last CPI print that we had, okay, on April 12th, the history of what had happened before. So you can see this is about 2 seconds before the data comes out then. But when the data comes out, here's the thing. Half the data was in line with expectation, but the other half was lower than expected. Okay, so again, just to make you aware, just a history. Don't think this isn't happening now. If you get confused, I have had that sometimes in the past. But as said, so the data was, you had half the data was in line with expectation, but there was also a decline in the other figures as well. So in the year-on-year, a 0.1% decline, and the month-on-month had seen a 0.1% decline. And that caused the S&P to move towards the upside and the dollar to see a decline and bond prices to go higher. Remember, when bond yields go high, bond prices go low, so vice versa. Okay, so that's what we had seen here, and I think we would expect a similar reaction. Let's say if the data is in line with expectation, but you get figures, a couple of the figures that are higher or lower than expected. If you get figures that are lower than expected for a couple of the prints, then you'd see a positive reaction from the S&P 500. And on the flip side, if you do see a couple of points that are higher than expected, particularly the core, and then the year-on-year, then you'd expect an appreciation in the dollar instead, and a depreciation in bond prices, and an appreciation in the bond yields. So just to make everyone aware as well, with market correlations, whenever the dollar declines, usually gold will see an appreciation. Remember, gold is measured in dollars. So the stronger the dollar is, the more you can buy of gold. If the dollar is weaker, the more money you have to pump in to buy gold. So then gold's price starts to creep up and go higher. So that was the last reaction there. I want to go to the market reaction. We've got about 5 minutes left to the release. With deviations, I want to quickly show you here. Deviations here showing you a history of how the markets have reacted to different releases. We're looking at the CPI print here. This row here being the latest one. So you've seen the initial market reaction for the S&P. So you've seen here 2 data points were lower than expected with a 0.1% deviation. I think we'd expect the same thing. Let's say if the data is all in line with expectation, that would be trickier to kind of determine which way the market goes, because then they think that maybe inflation is sticky, but there are other areas that are coming down. Or they might think, okay, inflation is coming down, but inflation. Excuse me. Well, let's put this. Actually, if we are expecting a majority for inflation, only 1 point, the core CPI year on year is expected to see a decline, right? Everything else is expected to be as expected. CPI month to month is expected to creep up to 0.4%. So if everything does come in line with expectation, you could see the market seeing a movement towards the downside, thinking, okay, inflation has gone up and is sticky. If inflation is lower than expected overall, and you don't get a mix of one point is higher and another point is lower, then you could see a movement towards, you could see a positive reaction from the S&P 500 if the data is lower than expected overall, and the dollar would see depreciation from that. But I think realistically, if you had a 0.1% deviation on 2 data points, and you had this sort of reaction with the Nasdaq had seen a 511 tick towards the upside, and after about 10 minutes of trading, it was up from the release by 609 ticks or 610 ticks. That does show you that if you do get a report that's a straight flush, okay, with either red or green, you'd expect a very strong movement. Maybe not up to what we'd seen in the past of 952 tick move. Let's say either way for the Nasdaq, but you still get a very strong reaction. So let me make that clear again. Data in line with expectation could cause the S&P to move towards the downside if inflation is still quite. If inflation is sticky. If data is lower than expected, then you'd expect the S&P to see an appreciation, with the dollar to see a depreciation, and bond prices to see an appreciation. The bond yields going down. If we're looking at of course, if data is higher than expected, then you'd expect the dollar to see an appreciation and vice versa. The biggest currency mover we'd seen here and in the past has always been the dollar yen. And if we're looking at the bonds, it's always the rate sensitive 2-year bond that has the biggest market reaction. So we've got about a minute left. Hopefully that kind of makes sense. That made sense for everybody. Let's get see. Okay, we've got 1 minute left to the release. Let's get TICKSTRIKE up and running as well. Okay, so got dollar yen running, S&P and bond prices up here. Just make it close with the US release ticks set. Okay, go. Okay. Whew. Right, less than a minute left now, about 30 seconds to go. Ten seconds. Okay. 4.9%, 4.9% lower than the forecast of 5%. CPI month on month, 0.4%, 0.4% as expected. Core CPI year on year, 5.5%, 5.5% as expected. Core CPI month on month, 0.4%, 0.4% as expected. So there you go. Data for the year on year ticked down lower by 0.1%, and there you go. Boom. S&P goes higher. So and then Canadian building permits. I don't think anybody's going to care about that, but there you go. So a positive reaction from the S&P 500, negative reaction from the dollar. Bond prices going higher, so bond yields going lower. That's a big old move. Okay, see where it goes. So at the moment, you're on the S&P, you're seeing about 87. Well, you'd seen 86 ticks. Dollar yen. Let's see what we had on here. So just from memory, that's not the biggest reaction. That's a weaker reaction from what we've seen last time on the S&P. I think it's about 110. What I brought up. I'll bring that up again. I'll also bring up gold too for you guys, so you can see that there. All right. Gold, yep, there we go. Nice. It did jump up, so I'm gonna have to go. Okay, it's about 105 ticks, 104 ticks there. 104 ticks there. Bond prices had a nice old jump. Okay. All right, it's 47 ticks towards the upside. Okay, US short-term interest rate futures rise after CPI report as traders add to bets on Fed pause in June. The only thing that the Fed might be wary of is that if inflation isn't coming down as fast as they want it to be. But again, markets, if they are pricing more of a chance of a Fed pause in June, maybe in the past we have seen that the Fed has kind of gone with what the markets expected them to go with most of the time. So that might not be a cause for concern. But definitely, if you're trading the dollar, then you're not having a nice day from there. Okay, so let's quickly go through some other stuff as well whilst I've got you here. So don't forget to like the video, share the video, subscribe to the channel. If you've liked the video, if you found it useful, definitely press the like button. Definitely subscribe to the channel. Get the word out there. Drop some bars. Drop us a review. Let us know. Or actually, you can drop me a review at tony@financialjuice.com, and you can get that. Your criticisms, your feedback, positive feedback over there to me, so that we can kind of use that for ourselves and show how well we're doing, or show some appreciation. Again. If you found the information useful, definitely like the video and subscribe to the channel. So other things to be aware of as well: FinancialJuice, what we can see here on the website. Ooh, let me get TICKSTRIKE out of the way. So FinancialJuice, the live voice and text service to keep you up to date with what's going on globally, what's going on within the markets, it has everything you need all in one place. Your voice newsfeed with your live voice, your newsfeed here with your text. Again, that's also live as well, giving an update to you here on what the expectations are with short-term interest rate futures. You also have your calendar here on the left-hand side, all in real time as well, with data that comes out. And you also have your need to know market risk. What do you need to be aware of during your trading session that's going to have an effect, or has already had an effect in the markets? And then of course use it however you want to use it. So if you are a day trader, okay, and you like to if you, as I said, particularly if you're a day trader, this information here or this site is going to be very useful. Key thing is, for retail traders, they don't have access to a live voice and text service. The big boys, investment bankers, okay, they have access to this because they want to know what's moving the markets, okay, what's causing the markets to react in a certain way. And then they can use information to capitalize on potential trades or manage their risk. Same thing you day traders want to do. What's moving the markets now? Why is the market moving in that direction? And how can they capitalize it or manage their risk? That is what FinancialJuice is all about. Pateliana says, I am day and night, Tony. Gold doesn't stop. Hell yeah, baby. Well done. And Dilshan, yeah, okay. Dilshan was also on the gold train too. But yeah, so that is FinancialJuice, a live voice and text service with your economic data in one place, your text headlines, and your voice feed to keep you up to date in live real time. So there is a link to that, which I'll put up here for you, to sign up to FinancialJuice, which is the link you have there. If you're not subscribed to the FinancialJuice already in the pro version, you'll get the light version, which has a delay, has adverts playing, and you don't have access to the news desk, i.e. asking us questions about what's happened within the market or what to, maybe why is the market moving in a certain direction, those sort of questions, right? You won't have access to that. But in the pro version, you do. So to get the pro version, first you have to have a free version you have to have an account on the FinancialJuice feed, with a username and your login. Activate that through email or verify it. Go back to the FinancialJuice site. You can click on the GoPro button here. Select the subscription that you want to select. Don't forget, we also have a lifetime offer as well, so that's also available there. And once you've selected your payment, then you've done your payment, then log out and log back in, and that will act as another verification step. And then they say, hey, you are now a pro member. So that's FinancialJuice Pro. TickStrike as well. There's also a 7-day free trial of TickStrike. So just to put it in simple ways, TickStrike allows you to measure order flow within the markets, or another way to measure how strong is the buying or selling momentum in different assets. That's in Forex, crypto, stocks, futures, ETFs and ETNs, and also your internals too, like your VIX or your ADD. So that's TickStrike there. I'll put the link here for a 7-day free trial of TickStrike for you to have a look at as well. That's in there for you. Have a little play with it. If you're not ready to go with a pro version of TickStrike, remember on the website you have a limited version of TickStrike, but you can, which is restricted to S&P, Eurodollar, oil, and Bitcoin, which doesn't allow you to kind of move it around. But still, if you want to kind of have a go with it, just kind of get to grips with what TickStrike is like, then again, it's there for you on the site. Again, like I said, everything's all on the site for you to have a look at. Now, the deviations that are brought up here, okay, so the deviations is also, as I said, if you found that information useful, particularly to those who subscribe to it, then if you haven't subscribed to it and you want to, and you're thinking, is there a charge? No, there is no charge. It's completely free. So you can see here, not just the US CPI data, but we're looking as well as, looking at GDP. I was going to do PPI tomorrow, but it's more or less close to the Fed's inflation goal. So the biggest reaction was going to happen with the CPI data, and in the past, PPI hasn't really had that big of a reaction as it had done in the past. So it's become less relevant. Still relevant, but not relevant enough for me to do a whole 30-minute stream on it and kind of go through it with you. I did put out the deviations though for it in the email on Sunday. So the deviations, as said, completely free, giving you an understanding of how the markets react to economic releases. The figure here, let's go with today's CPI print, last CPI print. So the first figure here shows you the initial market reaction going to the wick of the candle. This is all on a 1-minute chart, by the way. And then the figure in the brackets shows you the move 10 minutes after the release. If the movement is going in the same direction 10 minutes after the release from the initial market reaction, then it will be just left with the figure. Unless it's moving in the opposite direction, let's say here, right, where you've seen a choppy reaction and then it was 94 ticks up on the first candle on the Dow. Then 10 minutes later, it was down by 43 ticks. So unless it has the opposite direction, then it's moving in the same direction. Hopefully that makes that clear. Again, that's completely free. So I'll put the link in here for MACROACE. So I send out an email every Sunday. I am considering maybe doing it on a Monday. I think Sunday everyone's chillaxed. They're at home relaxing. They're getting ready to kind of gear up. Monday is like a time to go. So you can sign up to the main list completely free. You get a rundown, or a small rundown of what to expect in the Asia session, Europe session, US, and a summary of the weekend news, and also the links to the live streams, the upcoming live streams, all in one email. Short, not filled with graphs or charts or anything like that. I kind of discuss it here with you in more detail as well. All right, so there's a lot of people saying thank you. There's a lot of comments. All right, yes, thank you very much for your comments. Everyone's saying thank you. David F saying great, thanks as always. Yeah. Pat Liana says, actually, drinks on me for everyone. It was the thanks, Tony. I'll buy you a pint or 5. I don't know how I'll deal with 5. Hey, I've got a job here. I can't be like that, not on the job. All right. So tomorrow we have the Bank of England as well. PPI, like I said, I'm not going to be doing that stream anymore, but definitely do the Bank of England. Expected to raise rates by 25 basis points. So you can join me there for that stream. Remember, if you're already subscribed to the channel, then you'll be able to see it on the playlist as well. But for now, I will see you guys tomorrow. Enjoy the rest of your trading session.